Welcome to this explainer. Today, we're unpacking a really fascinating digital marketplace called Tradepesa. If you've ever wondered how a completely user-generated digital asset goes from just being, well, an idea in someone's head to a highly traded token, you are absolutely in the right place. We're going to focus strictly on the engine that drives this whole platform. It's purely community-driven pricing model. There's no corporate executives pulling strings behind the curtain here. It's a completely raw, transparent environment where pricing is entirely up to the users. So grab your virtual wallets because we're going to break down the exact math and mechanics of how all this actually works. Okay, let's dive right into this. Here's our roadmap for today. First, we'll look at the Tradepesa token economy. Number 2, the engine, supply and demand. Third, a scenario we call the follow-up buyer. Fourth, colliding trade sizes. And finally, the rules for winning trades. Let's get started. Section 1. The Tradepesa token economy. Before we can analyze the math, we really need to understand the sandbox we're playing in. This is a space where absolutely anyone can turn an idea or a product into a tradable digital asset using Kcoin. Just to show you this isn't just theoretical, take a look at the top row on this activity chart. There's a token called Live2, and it's sitting at over 2.8 million Kcoin in 24-hour trading volume. Right below that, KBTC is pushing over 1 million. These are actual user-created, tokenized representations generating massive, real-time activity. The stakes are real, the volume is absolutely there, and the prices you see are constantly fluctuating. But how exactly? Well, to answer that, we've got to look at the platform's core philosophy. It's captured perfectly in this quote from their own documentation. 100% transparent, 100% community-driven. No hidden fees, no manipulations. And honestly, this hits the nail on the head. This is the entire foundation of Tradepesa. There are zero middlemen. There's no central broker quietly adjusting prices to manage their own risk. It is literally just you versus the market, which, also means there's no middleman to blame if a trade goes south. Every single transaction is tracked, every move is fair, and prices are purely influenced by buyers and sellers. Moving on to Section 2, the engine, supply and demand. Let's look under the hood at the actual mechanical gears that make these token prices move up and down. So the crucial question staring us in the face right now is, how are item prices determined exactly? Think about it. If I create a token for my digital artwork today, and there's no centralized authority or company evaluating its worth, how does it get its price tag? And more importantly, how does that price tag change from one minute to the next? The answer is the absolute golden rule of this entire ecosystem. More buys mean the price rises, more sells mean the price falls. It's beautifully simple, right? If you've watched crypto markets, meme coins, or even traditional Forex markets operate, you already know this fundamental physics. When a new asset is listed, the price climbs as people buy into it, and it drops the literal second they start selling. Your success here builds real value directly through that classic tug-of-war of supply and demand. Which brings us to Section 3, Scenario, the follow-up buyer. Let's look at the game tape of a specific, documented scenario from the platform so we can actually see this engine in action. All right, picture this. Imagine two traders eyeing the exact same asset. Trader A jumps in first. Because of our golden rule, the price instantly bumps up a bit. For a split second, Trader A is actually down just slightly, just because of the premium of entering the market. But then, Trader B steps in right behind them and buys too. The engine reacts again, pushing the price even higher. This means Trader B ends up paying a premium that was caused entirely by Trader A getting there first. Now, what's really interesting about this slide is the twist. Trader A actually breaks even. Why? Well, because Trader B's subsequent buying action helped push the asset's price up further, which essentially rescued Trader A's initial position. But poor Trader B, they actually lose money right out of the gate. Because they were second to the party, they bought at a newly established higher peak. They literally need a third buyer to come in right behind them to push the price up further if they want to see any profit. It's just a perfect illustration of how every single trade directly impacts the user who comes next. Okay, on to Section 4, Scenario, colliding trade sizes. What happens when traders take completely opposite actions and use entirely different volumes? Let's look at an even more complex battle. Here's the setup. Trader A enters the market and buys big. We're talking 1,000 units of a token. This massive injection of demand violently forces the price up. Right after that, Trader B enters, but they take the exact opposite position, selling 500 units short. Now, because it's a sell order, the engine pushes the price down. But because their volume is only half the size of Trader A's, the drop is only slight. Basically, volume dictates momentum.
Let's put some specific numbers to this to make it crystal clear. So when Trader A made that massive 1,000 unit buy order, the token's price was sitting quietly at 1.00. That single massive action skyrocketed the price immediately up to 1.04. That is an absolutely massive leap in trading terms, and it was caused entirely by one large user moving the market. Then, when Trader B followed up with their smaller 500 unit sell, they pushed that 1.04 down, but only to 1.02.
So, here's the crazy twist ending to this trade. Trader A, the massive buyer who literally moved the whole market, actually loses money. Yeah, they bought high during that initial surge, and that subsequent slight drop from Trader B pushed their portfolio into the red by -60. They moved the market for sure, but they paid the friction cost for it. Meanwhile, Trader B, the small seller, they walk away breaking even. They sold short at that 104 peak, and the price dropped to 102, leaving them totally neutral with no real gain or loss. So the big mover took the hit, while the small surfer survived the wave.
And that leads us into Section 5, Rules for Winning Trades. Having watched the game tape on these scenarios, let's extract the absolute laws of physics for this platform.
Let's summarize the playbook here because this is absolutely crucial if you're thinking about jumping into the platform's practice mode. First, volume is power. Bigger trades inherently move the price way more. Second, smaller traders don't have to dictate the market. They can simply ride the waves created by the whales to find a profit or just safely stay neutral. Third, always remember that moving the market comes at a cost. The market mover absorbs the friction of volatility. And lastly, and honestly most importantly in a purely community-driven space, your real profits often depend entirely on what other people do after you. Which leaves us with this final, incredibly important question. In a purely transparent, community-driven digital economy, where there are absolutely no middlemen to protect you or to hold you back, are you going to be the big mover who dictates the market's direction? Or are you the wave rider, slipping in and out of the momentum created by others? Understanding these mechanics is step 1. Deciding your strategy? Well, that's step 2. Thanks so much for joining me for this explainer, and keep learning.